Well, 2022 is in the can. The stock market was down almost 20% according to the S&P 500, and interest rates are up over 7% at year end. There's a lot going on, and 2023 is going to be really interesting, so let's dig in now.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Welcome to the first Trending Report for 2023. This session we will be reviewing data as it ended last week on Friday, which was January 6th. And given the fact that we are at the beginning of a new year, it's always a great and perfect time to go back and look at kind of a macro overarching view of what we were dealing with. And for last year, I'm going to boil it down to two main issues. I want to talk to you about inflation and the specifics of inflation, what it's been doing in the economy, what it's doing to your pocketbook, and how that potentially relates over to the rest of the economy and therefore the stock market. And then we're also going to look at the market itself, how it performed in total last year, where the hot pockets were and where the really cold pockets were. Then we'll get into our normal analysis, where we will break the market down over the last 12 months based upon capitalization, based upon sector divisions, based upon the U.S. bond market, and then finally looking at international equities. So let's jump right in. Here we are with inflation. Keeping in mind that last year, overall inflation was 7.1% by the end of the year. Now, the high point during the year came in at about 9%, a little over 9%. In fact, I think it was 9.1% for last year. But with inflation, you're talking about all the various goods and services. So it's as if we take this bucket, we throw everything you can imagine in terms of goods and services into the bucket, we shake it all up, we dump it on the table, and we kind of look at what is the average. And that average is 7.1%. For the ending point of last year. But keep in mind that the economists, many of them will argue that inflation is running really even higher than that at the personal household level. And the reason they say that is because certain items are running at a higher pace of inflation than our other items. Excuse me, sorry about that. But these items oftentimes can be things that are very commonly used. So, for example, here we are with eggs coming in at a 49% increase, almost a 50% increase in eggs. And we see a 36% increase in airline and air travel, and then 34% in butter. This one's really an interesting anomaly. This is the first I've heard of this. So I'm not quite sure what is the issue here, but food at elementary and secondary schools up 250%. So kind of an oddity there. But we're looking at items that can affect the pocketbook, depending on where you live. Public transportation is an issue, being up 24%. Bread, which is always a common item that is pointed to, is up almost 16%. Chicken or poultry up 13%. Coffee, fan favorite, right? 15%. And then obviously very important over here, we have gasoline at a positive 10%. Overall energy coming in at 13.1%. And then when we get down here, you see some are coming in below as well. So we're just focusing on some particular items here, with alcohol coming in below, apparel coming in below, meaning they're coming in below this 7.1%. But then beef and smartphones, as an example, are actually coming in with negative inflation. So they're cheaper than they were prior years. So this is the argument for where inflation is and where it really is felt in your pocketbook. And also keep in mind, the feds are increasing interest rates with the idea that they want to cushion and taper inflation. It seems to be working. If you look at the inflation chart overall, it went up to 9.1 and then came back down to 7.1. So the question is, can they now make for a soft landing? We are seeing that payrolls are starting to cool off. There are layoffs and things that are going with that. Unfortunately, that is the negative side of what the Fed is pushing for. They're talking about the fact that they need the jobs market to cool off, which will also in tandem cool off inflation and can get things back under control. So that seems to be happening if you've been watching some of the headlines as of late. Now, if we take a look at the overall market for last year and we take the heat map approach, the first thing I should mention is right up here at the top. The overall stock market for the S&P 500 was down 19.4% last year, so almost a 20% decline. That's the worst stock market year we've seen since the financial crisis of 2008, 2009. But what I really thought was interesting was this statement right here. The S&P 500 had more down days than it did up days in 2022. That is not normal. I did not go back and count 2008 or 2009 trading days, but I do not believe that was the case during that period of time. But either way, it is very unique. Now, the market also had some positive spots, partly due to what was going on in the marketplace, which wasn't necessarily positive in your checkbook, but could have been positive in your portfolio depending on how you're invested. And that is all of this green right here in healthcare, all of this green over here to the right in energy. We also see some green in a few other spots. Here's aerospace and defense, and you'll see some pockets. But generally speaking, this is a pretty red heat map. Red meaning the market performed negatively, green meaning the market performed positively. So the big red area is right over here in the upper left. Technology was significantly down. Communications services significantly down. Consumer cyclical, and then specifically right here, auto manufacturers specifically down. Over here, we've got real estate. We can't forget what's going on in the real estate market, down. And then the lower left, all the financial items, banks, credit unions, asset management. Red, maybe not quite as bright red as right above it here in technology, but still red nonetheless. The brighter the red, the more the negative. The cooler the red or the darker the red, the less the negative. And then same on the green. The darker the green, the less the positive. The brighter the green, the more the positive. But overall, again, stock market, the S&P 500 was down almost 20%, the worst year we've seen since the financial crisis. So with that being said, let's take a look at what has occurred in that market over the last 12 months. But let's look at it, first of all, from a point of perspective from capitalization, going from large cap to small cap, value to growth, and then the indexes themselves. Then we'll take a look at the various sectors, the 11 sectors that make up the stock market. Then we'll take a look at the U.S. bond market. And then finally, we'll wrap things up taking an overview of the international equity markets. So here we go with our U.S. capitalization. Now, this data is similar to what we've been showing you. I kind of tweak it here and there depending on what I'm trying to show you or to try to make things simpler to follow. So right here, this blue bar, we've got the Vanguard Total Stock Market ETF. We're using that as kind of our midpoint, our benchmark, if you will, for the overall market. So then the question becomes, what's running above it up here? And what's running below it down here. Whatever's running above it tends to be providing strength to the market. Whatever runs below it tends to be dragging the market down. And then we're looking at it from a macro perspective, a meso, a micro, and a nano. So macro being the highest level, nano being the lowest or most minute viewpoints. And then the tilt is a combination of all four to just kind of see what's the overall temperature, if you will, of the market. So here we've seen that we've got mid caps and small caps up here towards the top, but the S&P 500 value did come in that top spot right now. Yet on the bottom, we've got the really large caps, the S&P 100, we've got small cap growth and so on. So it seems to be mid cap and small cap that are driving things. And then if we look at kind of the visuals, here's the macro, here's the tilt, and then here's the nano. So the overall overall total stock market, as you can see on a macro level down here, we've got lots of red. We're seeing a bearish trend, and you can just easily visually see that, although we've got these spikes in between. So when we're looking here you see at a short period or short term, the nano spike does bring it up, but then it again identifies it coming right back down. So overall, we're seeing macro, and on the tilt right now, overall, we're seeing bearish or red, just like we are in the macro scene, bearish or red. Now, if we take a look at the sectors, we get a little different view. So here we are looking in the sectors. This is the equal weighting of all the sectors coming in here, and that's the visual graphic we're seeing in performance to the right. So up here at the top, remember we were seeing healthcare was a positive back on that heat map. We also saw energy was a positive on the heat map. So energy is cooling off a bit. Healthcare is still up here in the top, but now we've got industrials, financials, materials, and so on. And then once again, we've got the same correlation in terms of how you can kind of view these visually. So we are getting mostly red through here, but we're seeing a little more peaks in green based on sector view than we were over on the capitalization. But right now, we're seeing this red downturn here at the nano level. And for the most part, overall, obviously, this is just a different view of the market, but yet the same market. So we are seeing an overall downtrend, even though we see these spikes in some of the shorter term views. Now, the bond market gets a little more isolated into the red. Here we're seeing the Vanguard total bond market as our ETF, our benchmark or our midpoint, if you will. Above it, we're seeing pretty much all corporate bond variations. And then below it, we are seeing all the treasuries. So the treasuries, the U.S. government stuff is down at the bottom right now. The corporate stuff tends to be where we're seeing more green, as you can see here, and green numbers, positive numbers on the tilt. And again, here's our correlations coming in down here, just as we saw a moment ago. But look at all that red. All this red down at the bottom. It's red throughout the whole period. We are seeing a very bearish bond market overall. At the nano level, we saw an uptick right in here, but now we are back to the red. So the bond market is definitely pretty soft over the last 12 months. And then finally, international equities. International equities are starting to turn the corner. Look down here in the macro. It was all red. In fact, if you went back during the pandemic, you'd see that the U.S. markets were definitely outperforming the international markets by a pretty significant margin. But here we are seeing a macro green, macro turn up right in this area in here, showing some strength for international equities. And again, seeing a lot more in the green, even though it's we can still divide the equities market. Look at this green level from here on up. We are seeing positive numbers on our tilt right in here. Seeing positive numbers. We only have Latin America that is showing negative on the tilt. So for now, the international markets seem to be stronger than the U.S. We will see if the Feds can land us softly with these interest rates, if that will kind of provide the underpinnings to keep the market or the economy in check, which will hopefully keep the market in check and turn things back around. But that will be yet to be seen as we go into 2023.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.